Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us now, Yeoman's Duty, early morning California, James Bianco joins us, president and founder at Bianco Research. Jim, the arch call here is your sticky inflation report. Let me digress from that to the theme of the morning. I've heard the word uncertainty 47 and a half times this morning. Is uncertainty an opportunity or not?
No, I think it's an opportunity. We've overdone the uncertainty thing. A bunch of academics from Stanford have put together an uncertainty index, and last week it hit an all-time high. Now, let me restate that. We have more uncertainty now than we did during the COVID shutdown, during 9/11, or during the financial crisis. Now is more uncertain period. It isn't. We're overdoing it right now. Everybody's gotten to the point where we're talking about the end of U.S. exceptionalism, which was a term invented 200 years ago by Alex de Tocqueville. So I don't understand why we're getting ourselves all worked up that this isn't just a 10% correction in the stock market, but this is the end of the American experience right now. So this is the type of environment where bottoms are made in markets. And I think that's what we've done last week. And it's being confirmed also by interest rates, the 10-year yield, also making a one-month high today.
The Stanford people doing this include Nicholas Bloom, who is definitive on work from home. This goes back 11 years to a foundational paper, Fluctuations in Uncertainty. So when is the when, Jim Bianco, on a time basis? How do you know when to take the opportunity of uncertainty and invest?
Yeah, that's a good point, because usually you want to wait until you get to kind of the overdone pace. And fortunately, this time we've got this index that Baker, Bloom, and Davis have put together that is at, like I said, a 40-year high. We've also got, talk, over-the-top talk, I think, about the end of U.S. exceptionalism, not understanding what that word means. Now, all of a sudden, 200 years of, the American experience has been reduced to a bad quarter in the S&P, and it's over. And so it's that kind of environment that you would look for a bottom in the markets. And that's what we've seen in the last couple of weeks, while the stock market, the S&P, has rallied about 5%. And yes, you're right. It's rare that you get it that as extreme as we've seen in the last 10 days or so. But at least it's been a little easier to identify this time around.
So, Jim, I'm assuming that the recession scenario is not in your forecast?
No, I don't think it is. Even when you hear economists talk about it, they'll say the soft data is very weak, but the hard data isn't, meaning the actual economic data is actually holding up and the opinion data is what's falling apart. Now, typically, the opinion data lags the soft data, the hard data, meaning that first the economy turns down. First, people lose their jobs. First, they stop spending. Then they turn pessimistic. But when they typically turn pessimistic first, when no one's losing their jobs and no one has stopped spending, that usually doesn't last. And that's why I don't think we're going to have a recession, at least at this point.
Jim Bianco, we're thrilled that he could be with us. I can't say enough, folks, about his call for sticky inflation. He was lonely a number of years ago when that occurred. Good morning on your commute across the nation. On the left coast, Jim Bianco, good morning on Apple CarPlay, Android Auto, and Sirius XM, channel 121. Paul?
Hey, Jim, Tom was just mentioning that, he and I and Lisa Matei, we hear a lot from our guests about uncertainty in the marketplace, and the market doesn't like uncertainty. How do you, when you talk to your clients and they're trying to figure out what this tweet means, what that tweet means, what this policy pronouncement means, how do you suggest they navigate all that?
I think what they have to start with is the premise that when Trump was elected president and his cabinet and his 80-odd million voters, that they voted for change, and that's what we're going to get. And whenever I hear people tell me, well, they're very worried about the tariffs, they're very worried, about the payment for security that we're demanding out of Europe, or maybe the sovereign wealth fund, or all three, I kind of go back to them and say, what do you think we should do if we don't do that? Going back to the status quo of $2 trillion deficits and massive treasury borrowing, that's what they're trying to move away from. So I've argued that we have to give this policy a chance to see if it works. Now, if it doesn't work, then we'll have to try a different type of policy. But I don't think we're going back to the status quo. And that's really where I think most people are struggling is this is not what we're used to. And so we're a little bit unsure of where we're going because it's new territory. But I don't think we're going back. And that's probably the most important message.
Do you see three, two, one? Jim Bianco, do you perceive continued use of cash by companies? Cam Dawson was in, and we're arguing about, selected Mag 7 is a utility holding because of free cash flow and quality of free cash flow. Do you agree with that?
Yeah, I mean, cash has taken on a very important role in this market. Yeah, and largely because it's got such an attractive yield. Right now, a typical money market fund will yield 4%. And that is more than the inflation rate. I'm still in the sticky inflation rate camp, Tom, but I'm in the 3% inflation rate camp. So a money market fund is going to give you a real yield, a yield above the inflation rate. So any company that can throw off cash. Cash is a valuable thing right now. It's not trash like it was, 5 years ago. It's not TINA. There is no alternative to cash like it was pre-COVID. Right now, cash is a competitive investment. It's outperforming the stock market this year than we've seen in recent years. So anything that can give you cash is going to be a positive.
Yeah. You see the math on that, Paul? You do triple leverage 4%. That's 12% gross. I take out my 210 basis points and everybody's happy.
Everybody's happy.
That's the way it works.
That's Jim. That 10% pullback we had in that peak to trough S&P 500, was that I guess what some would suggest is a kind of a healthy pullback in an otherwise longer term bull market? Or was it something different?
I think it was a typical pullback. You'll get one about every 18 months or so. The last one before this month was October of 23. So that was 15 months ago. That's about what the calendar would expect us to do. And we should do about 5% pullbacks a year in the market. That's the typical type of action. So for the moment right now, this looks like, a typical pullback. We had a catalyst with it. Just like in October of 23, the catalyst was a 5% 10-year yield. And that's all we wound up doing was the 10% pullback. And then the market kind of stabilized and it started to lift off from there. And I think this is what we're seeing right now.
Given that backdrop, Jim, where are you suggesting that people look for opportunity over the next 6 to 12 months, given kind of what we know about some of the uncertainty that's going to be, I guess, surrounding a lot of it, these markets going forward?
So while I've been very optimistic, look, we've bottomed, the market's going to recover and the like, I don't think it's going to necessarily blast through to all-time highs. It may technically make an all-time high, but you're not gone, I think, are the years where the S&P is going to give you 20%. So right. I think the aforementioned cash and the bond market at 5% yields in the bond market, I think are going to provide you a competitive investment to this stock market right now. And that's because as the market makes it back to the all-time high, I wouldn't be surprised if we start to see yields push well above 450 towards 475. And that'll be the newer concern for investors. Not enough to bring stocks down, but not go up.
What do you see on the labor economy? Your purview from Chicago, a la Diane Swank, is different. You're not within 3 idiot zip codes in Manhattan. The Fed models out to that singular headline, 4.4%. Do you model out to a higher unemployment rate?
Slightly higher unemployment rate. I think the biggest thing that we're going to struggle with is going to be the impact of the slowdown of migration into the country and what that means for change of population and everything. And I understand the argument that we might see higher unemployment rates as we move forward, but I suspect that it's going to be overstated, the amount of labor weakness that we're going to see from the labor market, and that it's probably going to hold up much better.
That's a huge deal. I mean, Jim, Torsten Slok published, I believe, yesterday or the day before, his new run rate on non-farm payrolls is sub 100,000. Is your new run rate because of a diminished immigration sub 100,000?
I don't think it's going to be that low because typically, if you're looking at the migrant workforce is usually not a workforce that gets a W-2, that has withholding taxes. That's who gets measured in the payroll report. So I suspect that will stay a little bit stronger. Now, in the household report, they can get picked up in that, and that might show up as a higher unemployment rate. So I'm with them, at least that there will be some weakness because of it, but I think it's going to show up in the other report, the household report and unemployment, as opposed to lower payrolls.
Jim, given all this backdrop here, what do you think our Federal Reserve, how do you think they're going to proceed for the remainder of this year?
I think the May meeting is the most important meeting of the year, because if they can't find a reason to cut rates in May, there is no reason to cut rates in May, because they've got the 10% correction, they've got the hand-wringing about tariffs, they've got the talk about a recession. And if we get to that May 7th meeting and they still can't find a reason to cut rates, then they're done for the year, and that the rate cut cycle ended last December. So I don't think they will, and I think that this means that they're pretty much on hold at least until the next cycle emerges. Maybe something else comes along that weakens the economy, or we start talking about rate hikes later this year or into next year.
For all of you across the nation, joining us now, surveillance sommelier James Bianco. Jim, out of Napa Valley, I mean, I look at the Screaming Eagle in Oakville, and it's really, really exceptional, but it is a different tinge than the wines of Rutherford in Napa Valley, aren't they?
Yes, this is a fantastic place to be if anybody can ever come out here and sip wine and enjoy the weather. I highly recommend it.
Which wine, which beverage of the wine do you like best? I mean, is there a certain nuance to the Napa Valley wine that Michael Barr should know about?
They all do. There's vineyards every half mile here, and each one is very different. And so, this is the wine connoisseur's heaven to be out here.
Is it as gorgeous as that Apple screen on Sequoia? Everybody's got this now on their computer screen. It's this gorgeous view of, I guess, Napa Valley. Is it that beautiful, Jim Bianco?
Yes, it is. I wish it wasn't still dark out. I'd flip the camera around and show you the view. It's unbelievable.
Well, you're a trooper to be with us this early. 9-7-6-5. Is that 6:15? Yes, 6:15 in the morning. Thank you, Jim Bianco.